If this is your first time here, welcome. During our shows, we interview successful entrepreneurs and investors to spread knowledge, advice, and actionable tactics to help others in the pursuit of financial freedom. We discuss successes, failures, systems, motivations, experiences, and key lessons learned along the way in the hopes that these stories help you along your journey. Tune in every Wednesday to get your weekly juice. If you've been here before and like what you've been hearing, please subscribe, share with friends, rate, and leave a review on Apple Podcasts. That goes an extremely long way for us. It's simple. Just click on your podcast app, type in our podcast name, The Weekly Juice, click on the reviews, and let us know what you think. The more ratings we get, the more eyes we'll get on our show, and in turn, we'll be able to provide you all with high-quality guests. You can also find us on Instagram at Weekly Juice Pod for daily content and personal finance tips to assist in your journey towards financial freedom. Welcome back to the Weekly Juice. As always, Ryan and Corey here with another episode for you. Exciting episode today. We had on financial advisor Ryan Breedwell. He is also the host of the Millionaire Mindset podcast. He's a wealth building coach, real estate investor, has his hands in a lot of different types of investing. I would just say, when I said exciting episode, Ryan is just a firecracker. He had a ton of information and we dove in on a bunch of different topics from financial advice. We also talked high level on insurance there's like 3 different types of insurance we go into, and becoming your own bank, just a lot of topics that we haven't specifically covered in previous episodes.
Yeah, totally. He was just like a book, like an encyclopedia. Like he just kept spitting out facts to us, and you could tell that he's really, really good at his craft. Like he really understands what he does. And that's the value that he brings to his clients, where he has high net worth individuals. A lot of his clients are real estate investors or professional athletes, but he breaks down terms for us in this episode and just gives us the straight hard facts. We get into cryptocurrency too, which is something that you and I don't really talk a lot about because we don't know a lot about it, but Ryan does, Ryan Breedwell, that is. And he broke it down and said exactly what his opinions of it are. And he told us the difference between cryptocurrency, blockchain, and Bitcoin. It was really cool. So it's an episode that's a little bit longer, but it probably defined more terms than many of our episodes out there. So let's see what Ryan has to offer.
Let's bring him in. All right, Ryan, welcome to Weekly Juice officially. We are super excited to have you here, and
excited to be here, man.
Thanks again. So if you could just give a little background on yourself, who you are, where you're from, and then where your, professional aspects lie here in the financial world.
Yeah, absolutely. So as you mentioned, Ryan, my name's Ryan as well, Ryan Breedwell, headquartered out of Sacramento, California. As many people think that LA or San Francisco is the capital, we have this little dirty town, a little farther south of San Francisco, called Sacramento. That is our capital. I live in a suburb right outside of that called Carmichael, moving up to another suburb called Rockland, closer to Tahoe here in about 2 months. My background is in financial services, specifically investment advising. My specialty happens to be most of my clients are ultra high net worth professional athletes or real estate investors, and the majority being real estate investors. I would say about 60 to 70% of my book. I think the thing that separates me a little bit from most financial planners, investment advisors, is I really like real estate. And although I know that's something that doesn't compensate me or pay me, it's definitely something that compensates my clients and pays my clients. And there's simply tax advantages, cash flow, things that we can do with real estate that we cannot do with other traditional assets. So I think it's a very complementary asset class to run alongside with other traditional assets. And I think the thing that kind of gets lost in the sauce sometimes is most people retire with only stocks and bonds, right? Like a 401k or something, and no real estate. So to think that it can't be done the opposite way, like real estate heavy with some investments on the side, I think is a fallacy. And a lot of advisors just have ego issues and they don't want to be the small piece of the pie. We don't mind being the small piece of the pie. We just want to help complement somebody's financial plan. And so that's where that kind of became a niche of mine. As I mentioned to you guys prior to the podcast, we have a little over $1.5 billion in assets under management, 14,000 plus clients around the United States. Anywhere where there's blue sky and an American flag, we can kind of work with you. So we have a lot of different clients in a lot of different areas.
Cool. Pretty cool story. I'm wondering if you could back it up even further and just talk about like the inception of like how you got into the financial planning space. I know you mentioned, we were talking before the show, that your dad started the company. Can you just talk about the inception and what you took to, like why you took to that field?
Yeah. So grew up right out about 30 minutes north of Sac is a town called Vacaville. We made it on Fox News this year because of the fires. So that was our big highlight of the year. My dad, when he was, low light. When my dad was growing up, he was kind of gleaning me to be in finances, not so pointed as where he was saying, hey, I want you to be a financial advisor, or I want you to take over the business, more so of, hey, this is how much money we make. This is how much money we make. We pay in taxes. This is why it's an important thing to do this. When we go to the grocery store, you can't buy your Pop-Tarts unless they're on sale. And I was like, damn, that sucks. I didn't get like, what is 30 cents? What's 30 cents on sale going to save us really? But he was trying to get into me being frugal. Fast forward through my high school and college years. When I originally went to college, guys, I didn't know what I wanted to do. I did not say, hey, I'm going to go study to be a financial advisor. I'm going to go do this. I honestly was playing baseball, went to Sonoma State, played baseball there. Had a good time. I was in a fraternity. Anybody who's in Teak, Tau Kappa Epsilon, that was the fraternity that I was in, social fraternity, kind of a fun one. Good or bad story. Sorry if I made some haters there. But I had a really good time in college. And then when I graduated, pretty much I did like what most people did. I got a couple student loans because my dad wanted me to be financially responsible for myself. And then I said, shit, I got to start paying for my student loans. So I got a job at a car dealership, Marin Acura, right outside of San Francisco. And I was driving about 80 miles round trip, and I made about $52,000 in my first year. And to not sugarcoat it, I essentially just said, fuck that. I'm not working that hard to make that little amount of money. I'm selling so much of my time, 3 hours a day in a car, and I'm getting nothing to show for it, except I can pay my bills and then rinse and repeat. A couple of my buddies had gotten into real estate, didn't really understand it at the level that I do now at that point. But I went and got all my licensing. This is at the beginning of 2015, got certified, got all that stuff, insurance, securities license. And then I started, and I took over the firm as the vice president in 2015. Fast forward to today, we've grown about 3 to 4 times what our assets were in that amount of time. We've added a bunch more specialties. We went from 2 office locations to 6, 70 plus processing staff, nationwide presence, national recognition, going on CNBC sometimes, Cheddar Business. So it's starting to really, really, really take hold. And I think the area, like I mentioned earlier, was the fact that 1, we specialize in working with real estate investors. And 2, we just have a no BS glass door approach. I don't sell people on performance. I don't show somebody like 25% a year and then have a compounding linear return of 25%, which is just a load of BS. I'm like, hey, we're going to invest a few times. We're going to take some losses. We just have a very palpable way of dealing with people. And then when people come into us and they don't have a ton of discretionary income and they do have a real estate portfolio, we're supportive of that. Maybe there's nothing we can do right now, but maybe in 2 or 3 years, if we make these moves, this is something we can work on you with. And so that's how we have chosen to work with our clients. So if I backed it up all the way and gave you the verbal vomit, the elevator pitch, that's kind of how we got where we are today. My father's still involved. He's still the president. A much more of a laissez-faire role. He pretty much does the pension planning and pension design for the firm now. I manage most of the assets, and I also do most of the, actually all of the like insurance planning. So that's where we are today. I have an assistant processor. I have another guy that hits phones for me up in Northern California. We're a pretty lean and mean team for how big we are. But that's a good thing because that cost gets passed on to our clients.
Appreciate that walkthrough. Can you, while we're kind of at the inception of this thing, just before we get too deep in the show, can you explain the difference between a financial planner and a financial advisor? I hear these terms thrown around left and right. I'm not sure if there is a huge difference and then you also mentioned earlier about, offline, the fiduciary, and just diving in there.
Yeah, they're somewhat synonymous. You like when you get a securities license, which is a license issued by either securities license issued by the Securities and Exchange Commission or FINRA, the regulatory bodies, or if you get a certification CFP or something like that through the American colleges, That gives you the ability to become and use the title financial planner, financial advisor, investment advisor. I generally use financial advisor or investment advisor because it, in our world, indicates your specific licensing a little bit more. There's no real specific way to say what you have, but generally financial planners will be brokers. That's the real actual thing. And then there's brokers and there's investment advisors. I am not a broker. I am an investment advisor. An investment advisor, as the SEC defines it, is the actual person who does the investing. I actually am advising on the investment. A broker, just like in all cases, is a broker. They find a product and a person who has the product. They find a person who doesn't have the product and wants the product, and they connect the bridge and mark it up and charge a fee. Generally speaking, 9 out of 10 financial planners, advisors, whatever you want to call them, are brokers. And the reason they're a broker is because not only can they charge a higher fee, they're allowed to then also charge commissions. I don't think that that's right. I don't charge commissions. I don't charge trading fees. And we try to charge the lowest assets under management fee. What's the difference? An investment advisor or an IA only is a fiduciary and is required and obligated to do what's in your best interest at all times. A broker only, or here's even more sly way to kind of move in my world. It's called wearing two hats. It's where you have a broker's license, like a Series 6, a Series 63, and you couple it with a Series 7, a Series 66, or a Series 65, like I have. And then you're a broker and an investment advisor. You will always end up brokering the deal, which the end result is the deal gets brokered, but you're allowed to act like an investment advisor until it's time to sell the deal. So a lot of people get put under the impression that they are working with a fiduciary, where the fiduciary gets the option to choose how they get compensated. And I will give you a hint. Most guys are going to take the money. So that's the biggest difference between a broker and an investment advisor. And again, I am an investment advisor, which means that I'm always held to my client's legal obligation to do what's in their best interest, which I think should be the way for everybody, in my opinion.
Yeah, we do too. But then now I understand the concept of why people think that there might be a negative stigma around certain financial planners and and what they can get away with without being transparent to their clients. So it's good to hear that obviously that's far and away different than how you approach it. I'm curious if somebody were to say to themselves, I'm looking for a financial planner or financial advisor. Maybe what are some of the questions that they should ask an individual like yourself in order to figure out who the right financial planner or advisor is for them?
Yeah. Probably the easiest one that people come up with is like their fees, but they don't know how to ask for the fees, right? So like if you went to a real estate transaction, and you asked your realtor, what's the commission I'm going to pay? They may tell you 2.5%. That's about the standard right now in our area, or 3%. But they may not tell you that the other agent's also going to take 2.5% or 3%. There's going to be closing costs. There's going to be cost to fund the loan. Those other fees aren't necessarily disclosed. So kind of in investment advising, and most financial planners will tell you what you're paying them. We do what's called a total fee disclosure, meaning this is actually all of the fees on your account. There's expense ratios. Maybe your advisor is charging trading fees. The custodian that holds the money is going to charge a technology fee. Is there commissions? What's your advisory fee? And then that's going to give you your total fee. So a lot of times when I go to people, the most common thing that I tell them first is, how much are you paying? I'm paying 0.5%, or I'm paying 1%. And I'm looking at a $300,000 portfolio. And I'm like, no, you're not. Little nugget of gold here. All the fees are public. A lot of people just don't know how to get them. You go to broker check, or you go to the SEC's IAPD, Investment Advisor Public Disclosure. They have a brochure, part 2 on that table of contents. It will say fees. It will show you all the fees you're getting charged before your advisor. And generally it's banded. So if we went to like a very large, like Edward Jones, I mean, they're charging most people 2 to 3% at the end of the day when you add up all the fees. That it like kills your returns when you rip off 2% or 2.5% compounded against your portfolio.
Yeah, definitely.
So a lot of people don't understand that. And that's the first thing I would say is, how much am I paying you and what are my total account fees? Second, do some research on the guy or woman, do some research on the individual. go to brokercheck.finra.org, go to investor.gov, type in my name, type in anybody's name. If they're a financial advisor, their name will pull up. If their name doesn't pull up, they're not a financial advisor, or they're not registered properly, or they're lying to you, one of those three. And lastly, what are we doing and why? And have you baked in losses? When you're making me a projection, have you assumed losses? Do you guys understand what I say when I use the term linear returns?
Somewhat, yeah.
Meaning, like, if I showed 7%, you would just make 7% every year. There's never more than that and never less than that. And it just compounds forward.
Right.
In a perfect world, that happens. But in a real world, that doesn't. So most of the time we like to do what's called a Monte Carlo simulator. And that normally will take 1,000 different random variations, negative, positive, neutral, average them out to a median and give you a result. And if you go on our reports, there'll be sometimes a negative 16% applied. You have to put in those types of returns. And if you do a Monte Carlo simulator,
year over year, you're talking about. Yeah.
Correct. With drawdowns and taxes and inflation baked into it. When you do all of that, things get a little less flowery, but they're real. And so that's one of the things that we make sure we educate our clients on. Hey, I can show you the stars and take you to the moon. I'd rather just do the opposite. I'd rather show you the moon. And then if we can get to the stars, we can get there. So that's another big thing, is making sure you're not being sold on performance. Big three things. Are you an investment advisor, a broker, or both? How are you paid and what are you charging me? What are my total account fees? And 3, what are we doing and why? And can you quantify for me over the next 30 to 35 years what that looks like?
Thank you. That's huge.
Yeah.
You mentioned a lot of your client, you're in high net worth clients at this day and age. Now I'm thinking about, and I know everyone has a different story or a different, I guess, blueprint that they probably are prescribed by you, but how do you suggest that someone gets their financial house in order? If they're like, they've got things all over the place and they're just trying to like, hey, what are my like core 4 or 5 things I need to get in order to be able to like dive all in on investments and scale to the next
level. To become that high net worth individual eventually,
exactly.
Right?
Yeah. First things first, obviously, if you have a car, and you're driving it and you hear a noise or something's going wrong, you take a look under the hood. So don't be afraid to look under the hood, and work with somebody or talk with somebody that's going to look under the hood for no cost and obligation. We do that all the time. If you listen to my podcast, we'll mention it 4 or 5 times a podcast. Text the word X-ray to 844-447-1555. We'll provide you a $1,500 to $2,000 full financial plan, no cost, no obligation. And we'll show you, like, this is what you're doing. And this is what this will likely result in. This is what we would suggest that you do. And this is what we would charge you to implement it. And this is likely the result you would get from that. Would you like to follow that advice? Yes, no, maybe so. I'd like to think about it. But mainly going through a full financial planning process. What's your Social Security going to look like? What's your taxes looking like? What are your distributions and what are they coming from? Actually looking at something, not saying I have $100. What's the highest rate of return I can make on it? Coming up with an investment is easy. I think coming up with a financial plan is hard, because anybody can download an app and put money into an investment. What that investment is doing is a lot more complicated. And that's where kind of people like me plug and play when people have issues answering that. When I get really sick, beyond going to CVS, I go to the doctor. I'm a financial surgeon. That's what I do. When it gets to the point where people don't understand or don't have the wherewithal to implement or don't feel comfortable doing that, that's probably a good idea to talk to somebody like me.
Love it. I think it's really interesting and awesome that you brought up the linear returns, right? Because there's you plug investments into a calculator and you talk about a 9% return over a 30-year period. And the automatic thought is, well, for people who are into fire, which we are, the automatic thought is that this is going to happen every year. For example, we have portfolios that are now looking like 25% returns after the dip, but coming backwards, even in 2020, 25% returns, because the stock market has done really well since that dip. But you're talking about an aggregated return, and to average it out, next year might be negative 6%, right?
Agreed.
To get to that 11%. So I love that you brought that up, because it's something that people don't think about. Which
I was going to say, to touch on that even more, if you wanted to peel back one more layer, where we're getting at when we talk about that is another fancy word. And so I'm going to use fancy words, but try to dumb them down. Sequence of withdrawals risk, folks. it doesn't take a rocket scientist to make money in an up market, meaning on the 28th, I was 5 days late and I was like, shit, this is the bottom of the market. I jammed, 35K into my deferred comp. I made about 77% on index funds. Stupid. That's a stupid high return for index funds, right? That's really high. But what I know is, had I been retired and I was taking withdrawals in January, February, maybe on a 4 to 7% drawdown schedule, because when we're on fire, we're going to have a little bit higher drawdown schedule as well in the early years and kind of bake that off. What happens in March and April when I'm losing 20% per month and then taking a 2% drawdown on that, or a 0.5%? That 0.5% is like 2% against my portfolio. So what you'll notice is, and I had clients in portfolios that we tactically managed, meaning we traded into gold, went long the US dollar prior to the dip. But when you have to move into assets to avoid losses, generally you're going to give up returns and yield. Gold is a non-yielding asset, but good hedge against risk. The dollar is not really great. It's like a commodity. It's a boom bust. We have to ride it up and then trade it and get out. So it becomes really hard. It's hard, guys, to recover money from a portfolio you're taking money out of and living off of when you've taken too big of a loss. And where most people run out of money in retirement, in my experience and our firm's experience, is taking too much risk and chasing too much reward and not guarding your nest egg. I would rather get a 5% positive arbitrage after my withdrawal than chase a 12% positive arbitrage after my withdrawal and risk the fact that I would have to rebudget my year should something negative happen. I want kind of an all-weather portfolio, not like Ray Dalio, but kind of an all-weather portfolio.
Now, does this sounds to me like you can hedge against all of this if you live below your means, right? And if you do that consistently, now, I mean, obviously you work with high net worth individuals. Living below their means and living below our means, or me and Ryan's, is totally different. But if you do that, you kind of you put that buffer in there, right? And you're not spending all that you make. First of all, if you do that, you can't invest anyway. This leads me to my next question. I know that you tailor your investment strategies to the individual. Personal finance is personal. So this may be a difficult question for you to answer, but I'm curious if you have an overall investment strategy that you could maybe play to the average human that's coming to you. Like whatever that looks like, they're 25, they're 30, let's say around our age. Ryan and I are 30, I'm about to be 30, Ryan's 30. Like, what is an overall investment strategy that obviously nobody's paying for in this podcast, but a little bit of free game before they do pay you when they bring you on board?
Well, most people that come to me are not in fire, but they'll try to do it. So what we say is, hey, I want to retire as early as possible. And if somebody says that, instantly in my head, I'm saying, great, we're going to do a lot of non-qualified investments, mainly going to do non-qualified investments. Real estate pops up, brokerage accounts pop up, overfunding life insurance, maybe doing a non-qualified, no fee annuity if we needed to, like something we can put money in that has no market risk. So we can take more risk with our investments and hedge downward risk with an insurance product. So there's a lot of different ways to skin the cat. But essentially, I would just ask that person, what are you looking to do? When are you looking to do it by? How's your risk tolerance? What do you like? What don't you like? Do you like to see income coming in from assets? Do you just like to see them appreciate? Do you like, are taxes a big deal for you? Or do you really not care about taxes and you'd rather just pay it and that makes you feel good? So back to your point, not having such like a cookie cutter way to go for it. We try to mitigate taxes first, because generally by mitigating taxes, we can keep more money in our client's pocket around what our clients are trying to do. Most of my clients, if I grab just into a bag and pulled them out, and they're a typical investor that hasn't said, I want to retire early or later, just as soon as, hey, they say, hey, yeah, I want to retire last week. Ha, 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 ha. Yeah. That kind of deal. I would say that they have a qualified account either through work, like a 401k, 457, 403b, TSP, what have you. That will be where we're trying to get maybe free money from work, contributing at least up to our match and getting 100% return on our dollar. Stupid to not get that. Second, we try to have a brokerage account, because those monies are not going to be tax-free or tax write-off, but they're going to be tax efficient. And if we're really smart and we're doing our fire and we can get our real estate to get our income under $88,000 as a married individual, we have no long-term capital gains. That could potentially be a no tax account. This is not tax advice. I'm not a CPA, so I cannot give tax advice. Second to that, a lot of my clients have LIRPs, life insurance retirement plans, that they bank off of to purchase real estate. And almost all of them have real estate, at least 1 to 2 pieces of property. And I think when you do fire, it's really hard not to have real estate because you're just going to get murdered in taxes. You're going to be in a 39% tax bracket. So having real estate is a good way to mitigate those taxes. Gosh, I keep hitting this. Sorry. Mitigate those taxes and then also increase our cash flow, because ultimately cash flow is king in fire. Our bigger our cash flow, the less, we have this X pattern. We're looking to sell less of our time and have our money buy us more time. The Mr. Miyagi of financial planning is very simple. Time buys money, money buys time. If you do not understand that concept, call any payroll company. They'll show you how much money they're paying out for people's time. That's what they do. They calculate that all day. That's all they do. So that, to me, and I think you guys and the listeners would agree, we would all like to amass the most amount of money, not necessarily to, be greedy or selfish, but because, and I talked about like this on my podcast today, it affords me the ability to do what I want when I want. And then I also don't have to worry about selling my most precious asset to somebody, because my time today is worth less than it is tomorrow, just like yours is, Ryan, just like yours is, Corey, just like yours is, Jake. All of our times are worth more every single day, and we have less and less and less to give. So I'm not going to grade against that asset more than it already is getting graded against.
Awesome.
That was awesome.
Really cool.
Two things in there that I wanted to have you touch on, and feel free any order here. I want to dive in on how to be most efficient with your taxes and kind of your experience with that.
Yep. Taxes. So I always have to preface everything because I'm a good financial advisor and I stay in my lane. A lot of CPAs think they're advisors and they're not. And a lot of advisors think they're CPAs and they're not. So always, always, always make sure that if you're making money, I think when you start to get into the 6-figure range and you pick up real estate, 2 things, guys. First of all, make sure you work with somebody who understands real estate. And 8 out of 10 CPAs don't. They do not. Ask them directly. I have real estate. Do you understand how to work deductions on my real estate as well as with my regular deductions? If they say yes, ask them for a reference. You can get references from a CPA. I'm not allowed to give out references. That's illegal. But a CPA can give you a reference and say, call this individual and ask them if I do their books well. That's the first thing. Second, do not be shy. I'll tread lightly on this because politics is still very aggressive right now. Be the Donald Trump of taxes. Who cares if you don't owe any money? Amazon doesn't pay any taxes. A lot of corporations don't pay any taxes. Do you want to know why? Because it's legal. It's allowable. They're not breaking the law. They're doing legal things. Please get it out of your head that it's bad to not pay taxes. I don't know who coined that or who got that.
If I can pay no taxes, I would pay no taxes. So
absolutely.
Yeah.
Absolutely. That makes if you can legally do it, legally is the first word, and be prepared to be audited and prove the legalness of your write-offs. So make sure you're keeping track of that, but do not be hesitant to take all and every deduction you are due. The tax code is written so that you can do that. I suggest working with a CPA, not a tax preparer or an agent of the IRS. That's a bunch of BS. Just work with a CPA. And the last thing is, if somebody is giving you advice on your tax return and they are not signing that tax return, that person is not giving you advice. You are taking your own advice, and that's your own skin in the game. My CPA signs my tax return under me. That way, if anything is wrong on that tax return, guess who gets to ride down the lightning bolt with me? My CPA. That's audit defense. Make sure you work with somebody that's going to be behind you if you get audited, is a CPA that has a track record of being successful, and don't be afraid to take your deductions. I've ran into so many people this year that were like, well, the coronavirus, and I just feel bad taking that deduction. No. Do you know how many corporations screwed over small businesses jumping in front of the lines on the PPP loans, and now those businesses are closed? Think for yourself. Number on your back mentality, guys, when it comes to taxes. Uncle Sam could care less about you. So make sure you take all the deductions that you can get. Those are my 3 tax. I have to tread lightly on tax advice. I wish I could go more, and I stay in my lane. I know enough to be dangerous, and that's pretty much it.
We appreciate that.
as far as it goes to with life insurance, what a fun avenue this is. Term life insurance is the most basic, cheap form of life insurance. It's the hedge risk. I have millions of dollars of term insurance and it costs me less than $200 a month. That's because if something happens to me, my beneficiaries, in this case, I live in a joint property estate. So my primary beneficiary is my spouse. She would get paid 100% of that money out. And I use that insurance to say, hey, when I retire, I don't need this amount of insurance. So I want to have this now so that when my working years and when I'm getting my bag, when I'm carrying my bag around, making my 7-8 figure income, that's when I need this amount of coverage. When I'm retired and I've already amassed my assets and those already have beneficiary designations, I don't need that amount of insurance. I'm wasting money on insurance at that point. Term insurance, the most basic kind, the kind you can get quoted for on the internet that you see on commercials. John can get a policy for $1 million for less than $20 a month, something like that. That's term insurance. Now we move on to whole life insurance. It's what your big box, most people want to sell you. It pays, like I said, the best commission, but it's because the contracts are more rigid. As a company, if you issue a more rigid contract, you can pay the person issuing that contract more money because their guarantees are heavier. Guarantees are expensive. Universal life, less guarantees. A lot less guarantees. We're going to go ahead and put the performance on the back of a market index. Thank God this market index is the hallmark of all stock indices, and we generally use the S&P 500. It's pretty simple. We're going to get all of our market return up to a cap. Generally, we're not going to get a dividend. So when there's market years where the market is down, a whole life insurance policy is generally going to get its time and day because it's going to pay a dividend. I don't know what dividend it will pay, but it would pay a dividend. Maybe in that year, an indexed universal life policy would not. But what I will tell you is the following years, it will probably get the maximum rate of return, which is going to be hand over fist more money than a whole life insurance policy. Then it comes down to the loan features. Most universal life insurance has 2 loan options, variable and standard. Most whole life only has variable and some has standard. Standard loans generally work themselves out to be what are called wash loans on both policies. The policy that I use with my clients has a wash loan available beginning in year 5, meaning they're going to charge you the same amount of interest that they're going to credit you. It washes the loan cost to 0. The negative on standard loans is that you don't do what you want to do with insurance. You do not earn interest while you loan it. That's why we want to use insurance. Variable loans, we do because there's a risk of it costing us money. Whole life insurance, you take a loan out. If you do not pay that loan back within 1 year, it starts accruing interest. And each year that you do it, it compounds. Universal life are non-termed loans, meaning when the loans come out, they never have to be repaid back and they simply accrue interest and the interest rate is reset on your anniversary date. They tell you a minimum and they tell you a maximum. The policy that I use has a 3.5% minimum variable loan and a 6% maximum variable loan. I have yet to see a whole life insurance policy that caps their variable loan. That's another big issue. How do we get credited? The best whole life insurance policy that I know out there right now, the maximum positive arbitrage you're going to be able to take before M&E, mortality and expense, is about 1%. I took a $120,000 loan out of my policy last year and made 10%. I would rather have less guarantees and have that opportunity or that potential than to pay an insurance company for guarantees, because I can guarantee you they're going to lower their dividend. They're going to take in more and more and more clients in a low interest rate environment, and they have to lower the dividend to pay them out and keep them happy. I do not want that to be a part of my investment experience. I'd rather use a market indice who has no emotion, who doesn't care, to drive my return with the same amount of market risk, which is 0. So that's the biggest differences between the two. What you will notice is if you put them side by side and run the merits out, 2 things that whole life insurance are going to do better. Early cash value, meaning cash value available immediately. Because guess what? They're going to force you to pay premiums till at least age 85. That's why. You have to pay premiums till age 85. Or would you wait 2 years and then know that you can shut your premiums off whenever?
So say you sign up for this, you can't ever back out. Is that the deal?
You can. No, you can. Just like if you get a shitty investment property, we can 1031 exchange and do a like kind exchange. switch the 1 to a 5. A 1035 exchange is a like-kind exchange between insurance products. You can do an insurance cash value to another cash value, and your cost basis also transfers over just like in a 1031. You can do a life insurance policy to an annuity. You cannot do an annuity to a life insurance policy. So that's cool. That's the only thing that I don't know why that is, but you cannot do that. So yes, if a lot of people do have these policies already set up, and a lot of times I'm fixing them or changing them. I've probably told you some things. You're like, oh, fuck.
Yeah.
That was told to me. That makes sense. Okay, that makes sense. Wow, I do have this. And the thing that we do, guys, that's a lot different is I'm not going to say, oh, here's your Mass Mutual life insurance. I have a big stack of them right here. Here's your Mass Mutual, or here's your Northwestern, or here's your New York Life, and it's garbage. I'm going to say for what you are doing, it's not going to do it the most efficient way. And I know a more efficient way to do it. And I can show it to you. And if you want to do that, you can do it. And if you don't want to do it, best part about it is just like before you met me, you're already doing it. You're already doing it. Enjoy.
Right.
Things I will caution you guys about and the negatives on insurance, phantom income. And y'all probably never heard of that because this is high level stuff. That's what we do. Phantom income. When you take a loan, if I had a credit card, guys, and I am swiping, and let's say I have a $1 million credit limit and I'm only spending $100,000 a year, but it's accruing interest. It's a revolving debt. We all know revolving debt is garbage, right? Because the APR is going to murder us. So let's act like it's a 6%, like most whole life insurance policies. Or if we have Northwestern Mutual, 8% on a 4% dividend. Robbery. That is going to start accruing so much interest that I don't have enough cash value or a credit line to be taking money anymore. And I'm about to use the interest off of my credit line here, the leftover cash value to pay the loan. Eventually the loan's going to get so big, there's not enough cash value.
I'm going to transition a little bit here into your infinite banking concept, because I'm really intrigued to know, it may be in layman's terms, exactly what this is and how you envision it and how it works for your clients. And just, if you could just dive in, people are probably very interested to know.
Yeah. Using that same exact style policy we were just talking about, we overfund a life insurance policy. We loan off of that policy. When we loan that money, I'll use some round numbers. If we took a 4% loan cost, right, out of the policy that I use with my clients, we would then try to, let's say we took $100,000 out and we had $1 million in our policy. First thing about infinite banking, why is insurance a good idea to leverage against? It's the only asset class that when we leverage against, we do not lose value on the asset we're leveraging. So if I had $1 million and I take $100,000 out of my life insurance policy, the insurance company is going to act like I still have $1 million and credit my policy like I still have $1 million. Second, whatever my loan cost is, that's essentially a spread. And I just am trying to cover that spread to make a positive arbitrage. So if I made a 10% return on this amount of money, how that would work is I would make 10% on $1 million, which is $100,000 of interest. They would add that $100,000 to my policy. Second calculation they would do is say, what is your loan cost? 4%. What is 10 minus 4? It's 6. And what's 6% of 100,000? $6,000. They would pay you $6,000 to take that loan. Hopefully you have a third vertical here and you purchased a piece of cash flowing real estate. You're going to burr that or you're going to hold it. And one way or the other, if you burr it, you put the money back into the loan, rinse and repeat. If you're cash flowing it, you simply hold that loan out until it's paid itself back. And then you rinse and repeat off with a new loan. That is infinite banking. The beauty of it is earning interest on an asset while you're still using it. Most of you guys listening to this show pay interest to use money, not get paid interest to use money. That is the basic concept of infinite banking. Banking on yourself. You can go loan from an institution. You can go loan from a private money lender. You will pay that person interest, or you can loan from yourself and pay yourself interest while you're still earning interest on a tax advantaged asset. That's the beauty of infinite banking. Wow. What ends up happening is we get to add a lot more to our real estate portfolio a lot quicker because there's zero underwriting. There's no constraints on what you can spend your money on and no term on the loan. I mean, you could take the loan out for 7 years if you want to, and nobody's going to be worse the while because you have it out. So it's a very, very, very efficient way. The flip side to that is the policies that I use generally take 2 to 3 years to get seasoned or capitalized. And then that's the drawback, the waiting period of using it. But if you can wait and you can season those policies and then get them to the point where they're ready to be used, there is not a better vehicle to take loans out to purchase real estate. I have not seen one that works as good, because even if I don't want to earn interest, I can take a 1.25% loan in years 1 through 5 and a 0% loan every year thereafter. And I'm taking loan on interest. I made 10% and I'm taking a loan at 1.25. That's still net 8.75 to me. So that's still a good way to use that money.
Wonderful.
Before we go into I kind of want to go into the podcast too, but before we do that, I have to ask, because we have not talked about this with any guest on any episode. And I'm just curious on your thoughts briefly on cryptocurrency and I
knew it was going to come. There we go.
Where you see that going, because I'll be perfectly honest. I don't have any interest in investing in it because it's something I do not know. And I don't want to invest in something I'm not aware of. That doesn't mean I won't become aware of it and then in the future invest in it. But it doesn't seem like something that I want in my portfolio, although I'm hearing obviously through a lot of people that it may be the future. I'm curious what, your take is on it.
God, what a good question, and something I get asked quite often, especially this last 6 months. It was cannabis stocks for a little bit, then it went back to the other stuff, which I would like. If I could invest in cannabis stock, I would prefer to do that rather than cryptocurrency. I
invest in some cannabis stock. I didn't put enough money in, but something just went crazy out there, so it's been good. But go ahead about the crypto. Yeah,
I think that it's a fallacy to think that when a government, one of the main functions of a government is to manage and maintain a currency, that they will not do that. And I also think it is a fallacy to think that a government will adopt a fiat currency just because the public says they want to.
Right.
It doesn't really kind of work that way. And banks won't do that. The dollar backs every other currency in the world. It's the World International Monetary Fund and the World Monetary Fund's safe asset choice. And it would cost the United States a lot of money. They would lose a lot of money if they did that. So I'll burst the bubble for everybody. Bitcoin, I'm not going to say cryptocurrency because I'm going to speak specifically to coins. Bitcoin will not be, I have a podcast on it. You can Google it, Ryan Breedwell. Bitcoin, never a good investment. I promise you, I mean that. Never, Never. Never. Blockchain is the real deal, guys. That's what it's about. And where I'm getting more excited than cryptocurrencies or fiat coins is decentralized finance coins, DeFis. How do we take money and decentralize it so we don't have to ask somebody to put trust in a financial institution and they don't have to charge a fee for that trust? And then we can get full trust and transparency by doing our regular financial transactions. Let's take the dollar and let's improve it. Let's not take the dollar and get rid of it. That will not happen. It won't happen. I could want it, and I'm not going to say I do or I don't. I know that it will not happen. It's not. Bitcoin's value probably will go next to nothing eventually because it's the original. It's the whole life of cryptocurrency in my world. It does what cryptocurrency is designed to do the slowest way. So it's 7,000 times slower than Ethereum on processing transactions. Ethereum is slower than Ripple. And then what you'll notice is if you look at the everything just keeps improving. So down to where you can, you have wrapped Bitcoin and Bitcoin Cash and Zcash and Tether and all this other stuff. Who knows what's going to be good? I think the more acceptable space for institutions to do custodial stuff with, even though BNY Mellon said they're going to start doing custodial transactions for Bitcoin, some other big players, Tesla throwing money into that, which I did a podcast on, which I believe that was to pump their stock price because there's a 96% correlation between Tesla and Bitcoin. I'm not a fan of Bitcoin. Full disclosure, I own a lot of Ripple and I own a lot of decentralized finance coins, which I'm not going to say which ones. You should do your own research and invest in areas that you feel have a potential, knowing that it's purely speculative. It has no basis of being right or wrong. It just could be right. And if it is, it's going to make you a lot of money. So in comparison on like percentages, I would put like 0.1% of my annual income towards that kind of stuff for fun. And I put the rest of the stuff towards real, tangible, hard assets, dividend paying assets that are proven. I just do what rich people do. Rich people don't own cryptocurrency. They own real estate and stocks.
Very cool.
What's blockchain really quick?
Blockchain is a general term on a transactional process. I wish I was more of an expert on it than I am, but I'll do my best to give you my understanding of it. Right now, when we send data, it's very archaic. It's in a linear way. We send it maybe encrypted to a institution. That institution has to process or code that data. Then they have to either act upon it or send it off to the next party. A lot of people like to compare money transfers when they talk about blockchain. I like cryptocurrency and have liked it for the fact that it can move money in a more efficient way, quicker, which saves money on fees. That to me makes a lot of sense, because right now when people want to send money around the world, which is more and more and more popular, they're kind of pinned to using like 3 or 4 banks that are going to charge a little fee, just taking their little piece of the pie along the way. So ended up, to get $1,000, we're going to have to send, 1,240. And that's an old way of doing things. Blockchain decentralizes and takes away the banks and kind of uses people's computers in not in a way that is charging a fee to the client. And the fee that is charged, if there is any, is minuscule, and it normally will pay or mine off a piece of that cryptocurrency to run that transaction. You'll get rewarded for running that transaction. So not like a third party entity that nobody has any, skin in the game with. You or I are running on Bitcoin or Ethereum or whatever, and you're sending a payment, Ryan, to Corey, and it goes through my computer. I'm going to get a minuscule piece of that coin, and I was rewarded for hosting that transaction. That on a very, very, very minimal scale is how cryptocurrency or blockchain works, and why I think it's very, very has a lot of applicability. Real estate, transfer of money, stuff like that. Anytime your large pieces of information or assets have to move, they can move quicker and more efficiently through the blockchain.
I like how you just made the distinguish between the two, because a lot of people think they're synonymous. And I, even including myself at some respect, didn't know really the difference, but it sounds like it's not even like they're. I would say
even a way to think about it is a car has an engine, but a tire is the technology that makes it move.
Got it. Yeah.
Think of blockchain as the technology that makes cryptocurrency or whatever the currency, fiat coin you want to say, that's what makes it move. It is the lifeblood of why it is doing what it's doing. There's a lot
which you feel has a lot of value. And now that I'm understanding it, it makes a lot of sense.
Yeah. I think that a lot of finance guys, again, their ego gets blown out of proportion and they say, no, because I can't bill on it. And I want a lot of people to understand I'm not saying no to Bitcoin, because technically there's a Bitcoin, Grayscale Bitcoin Trust. I can buy that and I could bill on it. I'm just not, because I make the same amount of money my clients make. We get billed on the amount of assets we build, and I don't want the portfolio to go down. So I'm going to put it in areas that are going to make the most amount of money for my clients. I think right now it's just, even though, it's popular because people have had a lot more time at home. I promise you this conversation would have been forced to be happening right now if people weren't at home. It's still very much in its infancy. It's just very much in its infancy, just like retail investors beating hedge funds. It until the data comes out, it looks like you are. And then, Citadel lost 3.1, but Wall Street made about 27. So
right.
It sounds good. It's just not there yet. And I think what eventually will happen, just like always happens, is something will get good. And before it gets too good, big institutions will buy it up and make it their own.
Got it.
That's my opinion.
Thank you, first of all. Second of all, let's kind of transition in here to the Millionaire Mindcast podcast. And can you just give us some detail on the inception of the podcast, why you guys jumped in on it, what specific topics you talk about, and, specific guests that you bring on and why you bring them on?
Yeah. So, I had the ability of being added to Matt's podcast. So he says, this is our podcast now. I still like to make sure people understand that I did not found this podcast. This is not my baby. I have the blessing, for lack of a better term, of being able to be on it every Wednesday. Matt's been doing the podcast for 5 years, I believe now, 4 or 5 years. 2019, towards the end of the year, November time, he asked me to come on. We did a Wednesday segment. Downloads shot through the roof. People were writing back in, please have this guy back on. I came back on for another Wednesday. I came back on for another Wednesday. And he said, hey, me doing 3 shows a week was a lot. Having 1 show a week with you is a lot easier. And it lets me focus on the stuff that I care about more, which is interviewing the guests that come on. Mondays, we have a guest. The criteria is they have to have made over $1 million or have a net worth over $1 million to be interviewed. And then Friday, we do like a motivational. Matt will kind of just get on, break something down, and do a motivational. Wealth building Wednesdays, exactly what it sounds like. All things money and anything that has to do with money. That podcast has turned into a great platform where we, just like you, educate your listeners on all sorts of topics, whatever is kind of relevant at the time. And we can kind of couple that with world activities. That is how that podcast functions. It is a information black hole, for lack of a better term, on anything. We will talk about anything, the riots, how that affects the economy, how that affects small businesses when those were going on. When we had the election coming up, my bad election predictions and what those were looking like and what I thought that might do for the economy and everything, but it all has to tie into money. So it's kind of how money moves the world in a sense. And people really, really, really like that. And I think the same response that y'all have gotten on your podcast, where people like to get value and they like to listen to people who are easy on the ears. That's what we provide to our listeners. Yeah.
We want to transition to my favorite part of the show. It's called the Core Four. And essentially it's 4 questions just to get to know you a little bit better and provide a little bit of advice for our listeners.
I'm ready.
Cool. First one, we'll keep it simple for you. What's your favorite investing or business book and why?
My favorite investing book that I like to give away to our clients a lot is The Power of Zero by Ed Slott, David McKnight. It's updated every year on the tax cuts. The last time it was updated was 2018 because that was the last biggest tax cut. And it kind of talks about how to use life insurance, investments, trusts, and how to use those buckets properly and to draw down from them to get to a 0% tax bracket legally. That is a book that I really like. It's a super easy read. I've never sent it to somebody and they said, man, this book sucked. It's just good information. That's probably my favorite book. Right now, I am reading a book and it's a little dry. And so I'm going to be lame here and say this, but it's called The Safety First Retirement Planning by Wade Faw, who's a PhD. And it talks about the statistics and why it's very important to avoid risk, that drawdown, exposure in retirement planning. And so for somebody like me that has a lot of people that are 58, 60 plus that give us their life savings, that's been a very eye-opening book for me on some of the parallels of what we're doing and why, and how to educate clients on, hey, we don't need to chase 30% returns anymore. We need to see how much money our money can pay us in income. So that transitioning from taking big returns to seeing how big our paychecks can be from our investment portfolio. That one's been interesting for me.
Got it. Love the total. I mean, after you saying this, it just brought to my head, like, just totally respect what you do because you're consistently having to learn and grow and adapt to the new times of what's going on. And then you have a lot of weight on your back with high net worth individuals. So it's really cool.
Yeah. And on the book, I think I mentioned this to you guys, but I'll just say it on your podcast. If anybody will shoot me a DM or you guys a DM, at least for the first 10 people, I'd be happy to provide. I'll FedEx you a hard copy of this book to your address of choice for no cost, no charge, no obligation. So you guys can educate yourself just for being a listener on the Weekly Juice podcast.
Love it. Love it. That's amazing. Thank you. The second question of our Core Four is, what has been your biggest mistake that you've made in your investing or business career, and how have you learned from it?
I think, and this is probably a common mistake that a lot of people have made. So I think I can kind of assimilate with a lot of people here. Taking a loss and not recognizing the victories that I could get from it. So maybe losing money on an investment and being, not having my dime in hands, being soft-handed and selling off that investment, and not being so. Having an investment was my biggest mistake, not having a financial plan. That's what I mentioned to you earlier. whenever I make an investment or whenever my clients make an investment, it needs to have a plan behind that. I don't just whip up a cake and throw it in the oven and then just go sit on the couch. I need to put a timer on. I need to know, I need to check it. I need to do the little stupid toothpick thing. It's cooked in the middle. You need to have a financial plan. And I think that a lot of people get caught up on when they build wealth that they want the microwave approach because it's very convenient. I have those little crack and egg things. I like to have them for breakfast. You throw the egg in there, you whip it around, 70 seconds later, you got some eggs, right? But I think you would be lying to yourself if you said a scramble that's made in a pan wasn't better. So Matt says a terminology that I really like, and it's real wealth is built in the crock pot, not the microwave. And I think for a long time, I was so focused on the microwave mentality, I was getting microwave results. Don't get me wrong. In college, I was the guru of the microwave, but better things are made slower with time, with process, and you get the results from that. So my biggest mistake from an investor standpoint, not recognizing the victories that I got from a loss, because I'm one of the biggest losers you guys will ever have on your podcast. That's why I win so much, because I know how not to lose anymore. And then second to that,
you've made those mistakes.
Exactly. And then second to that, being so short-term focused, I can't see the long-term results that I'm going to get for making the choices that I'm making.
Cool.
Love that. Number 3, who is your who for 2021? And you feel by meeting this person, your business or personal life will be propelled to the next level. And if you can't think of someone that you want to meet, who have you already met that having met this person has taken your life to an exponential level?
I really am a big fan of somebody that pops on CNBC sometimes, Mohamed El-Erian. He is the ex-chief executive officer for the International Monetary Fund. He is a advisor for Allianz, contributor for Forbes. Sits on the board of Microsoft, IBM, Intel. Smart dude when it comes to money. I would love to meet. I have met him, but more on hello, you're one of the top producers. Come and take a picture and shake his hand. I want to like the Warren Buffett lunch or breakfast. I would love to come and spend time talking to him because he is, besides my father, who I consider pretty epic. He is somebody that I would love to pick their brain on cryptocurrency and the short squeezes that have been going on, how he sees that the retail investor being recognized over the next 5 years. How is that going to change? Those are questions that somebody like that caliber would answer. And he's, overseen over $1 trillion in assets. That's a guy that I would really, really, really love his opinion, because when you have that much behind you, there is a reason that there's been that much assets entrusted in your care. So he's probably the person that I would say that's my who for 2021, Mohamed El-Erian.
Pretty cool. Pretty big goals there. So I love it. Last question for our core 4. What do you want your legacy to be? It's a deep one.
Yeah. My goal before I retire, I would love it, is to personally, in my personal book, have $1 billion in assets that I manage. We oversee a book of 1.7 billion. You would be able to tell quickly I'm a liar if I said that was all mine. It's not. It's not all mine, guys. We have a lot of other advisors in different states. We group our assets together. It's all one roof. But having $1 billion of assets that were under my personal care, that I knew that I could still give those people the exact same service that I give them today, and then being able to pass that on to, at that time, my brother's 10 years younger than me, so maybe passing that book on to him. So that's my legacy. It's just kind of cheesy to say, but leave the world a better place. I want to leave. I don't know what that means to me, but I know what it means. And I want that at some level. I want to be able to say that when my name is brought up, there is a story behind it that's either funny or good or both. And that maybe could have a proactive or positive spin. I think that would make me the happiest, whether I'm writing, politics and religion are the two most polarizing. So whether I'm looking down in a cloud or riding off in a spaceship with an alien, whatever you want to think, that would make me the happiest, I think. But ultimately what makes me the most happy, And kind of the legacy that I get to build for other people is just making a plan and watching it work with clients and then watching the clients be happy. What makes it for me now is helping people. So being able to have that legacy, if that could be my legacy, Ryan was a person that always helped people and he did what's in people's best interest and he carried himself above the line. I would love that to be my legacy with a nice big book of business behind it.
Love that. Thank you. Last segment of the show is the last drop. So question for you is, knowing what you know now, what advice would you give to your younger self if you could go back in time?
Good one. I remember reading over that. That's a hard one. Cause 2020 hindsight, right? Man, I got a lot of shit. I got a lot of shit to tell myself. I got a lot of, it's the best and the worst. I'm a windbag, guys. That's why this interview is going so long. I could sit here and think, man, I wish I wouldn't did that. I wish I wouldn't have did that. I wish I wouldn't have did that. I think probably I might be one of your only people that says I probably wouldn't change anything. I don't think I'd do anything different. I think that where a lot of people make a mistake is looking back on your past and not taking advantage of this roadmap of what to do in the future and dreading recollecting on that. So I don't think I would change anything that I did in the past. I don't know how I met my wife. Wife is way out of my league. So I don't want to mess that up. I'm in a pretty sweet position as far as for work and finances go. I have no kids. I have 2 dogs. I do whatever I want when I want to do it. I don't think I would change anything. But what I would say, if I could do anything in addition to what I have done, maybe that's how I'll answer it. I would have started investing a lot younger. I would have over $1 million in my investment savings, which I don't have right now. I'm in the hundreds of thousands, but I would have well into the millions if I would have started 4 years sooner. Same amount of money, 4 years sooner. And it's learning that compounding interest works for you or against you. Huge concept. And it doesn't take a lot of money to make a lot of, well, that's a fallacy. It doesn't take a lot of money over a long period of time to make a lot of money. Right. It does take a lot of money to make a lot of money, generally about $1 million to make 50 to 60 grand a year. But holy cow, that would be the thing I would add on. Hey, 21-year-old Ryan, open a brokerage account and start putting $100 a month into it. You can afford it. And another thing, don't tell yourself you can't afford something. You can afford something when you start paying for it. That's how I thought about my car payments. That's what I thought about my house payments, and I pay them all today. So those 2 things, don't think you can't afford it and just do it. Nike style, man, just do it.
Cool.
Start young.
Very important. I think it's important to touch on that. I really like that you said you wouldn't do anything different. Obviously you added things you would do in addition, but to own up to the trials and tribulations that you've gone through in the journey, right? That's the most important part. Mm-hmm. You know, you try to figure out your legacy down the line, and that was a harder question for you, but like going through things and having those experiences has made you a better person,
agreed.
You've enhanced your craft, like a lot of different things. So I think that was really cool to touch on that. So I appreciate you being so open and honest. But if people loved the show and loved you and just want to get to know you a little bit more, maybe network, where can they find you? Feel free to plug Instagram, brand, et cetera.
Yeah. You can always go to, please make sure you like, listen, and subscribe to this podcast and leave a comment on the Weekly Juice podcast, because I wouldn't be able to be talking to you guys without that. Maybe a lot of you guys are coming over from my podcast because I plugged you guys last week on this one. Go check out my podcast. Check out this podcast. Hit the subscribe button. Make sure that you listen to us and what we have to offer, because we have guests that come on that can provide value, and so do you guys. If you want to talk to me, you can connect with me on Instagram. That's the best place. Don't go to Facebook. I don't have one of those. And I use email, but best place is to DM me on my Instagram. I personally will DM you back. My handle is @RBreedwell. RBreedwell. Very simple. If you want to text me, I am sorry I don't give out my personal cell phone anymore because it started getting too crazy. But you can text the word X-ray if you want me to check out your investment portfolio to 844-447-1555. If you want to set up a review of an insurance policy or talk about infinite banking or how life insurance can be a part of your retirement planning as an asset class, go to www.becomethebank.info, fill out the form, and I will also give you a call. the one thing I would encourage you guys is nothing changes if nothing changes. So if you are in a spot and you want to take a check on something, just check on it. At least I can tell you, and you can be validated by me being brought onto this podcast. I really mean that if I show you something and you don't like it, you will not be forced to do it, and you can take it and run away. But look, see what's out there, because just like you stumbled upon this podcast or my podcast, you have to take an option or a look at it before you know what you're getting yourself into. So those are the best ways. And like I said, if anybody DMs you guys or DMs me, the first 10 people that do, I will send you this book, Power of Zero, for free. I need you to tell me where to send it to, but I'll pay for the FedEx and everything. And I will overnight that book to you for free, and then set a free phone call with you to go over it and the concepts. And if you think there's something in there that can help you, I'd be happy to help. But just take that leap, reach out to me, connect. I'd love to tell you about the events that I go to. I fly all over the United States. I speak at them all the time. Let's connect. Let's get a beer. Let's get a cup of coffee. That's how I talk with our listeners and my clients. So let's do that.
Wonderful. Awesome. We really appreciate you coming on, Ryan. We think that, I mean, it's evident, it's really evident how much knowledge you do have. My head was spinning in a good way during some of the concepts that you were going over, but I think that it's really valuable for people to reach out to you and learn more and work with you and your team. I'm even thinking about it from my own, I feel like I know what I'm doing. I have a very clear vision, but I don't know what I don't know. Right. So it's thank you very much. We really appreciate your time. And Ryan, you got anything?
No, thank you very much. We really appreciate it, Ryan.
Appreciate you guys. I hope to talk again soon.